taking control, making sure you like maintain your power, don't give your power away to anybody. That I feel like is the key to like truly being happy.
Hey, bro, you better get ready to buckle up, because this shit don't get no easier. What, you think the grind gets easier? Come on, bro, you silly, man. This grind's only for the strong ones, bro. And if you weak, I suggest you go ahead and leave. It's tough, but it's true. Be safe.
Know who I am. I know I'm important. Like, I know my worth. I ain't gotta walk around thinking I'm bigger than nobody. The only person I'm trying to be bigger than is the person I was yesterday.
I think you just gotta know what you stand for and know what you represent, know what's true to you, because you can't please every.
What's happening, everybody? It's your boy Creative, back at it again to create something great. It's my first time going live on YouTube, so say what's up. I really do appreciate y'all joining in on with us today. What we're going to be doing is building out an Algo bot, right? So I'm just going to wait for a couple more people to get in, and as you all are rolling in, my name is Creative. If you do have any questions, please let me know. Here at Creative Coder, what we do is we strive to be able to create different coding projects, right? Whether it's, excuse me, trying to find the, again, it's my first time doing this, so y'all, just bear with me. Okay, back, set up later. All right, here we go. And you should be able to, again, y'all forgive me, first time doing this on YouTube. I'm used to doing this on Twitch, right? So just give a minute. Hold on. All right, here we go. Here we go. Here we go. All right, perfect. Perfect. All right, I can see everything. Everything is good. Let me check my levels. My levels are perfect. All right, so let's get this started. So, what's up, everybody? My name is Creative, and here at Creative Coder, we aim to be able to create different coding projects. And today, we're going to be building an Algo trading bot. With this Algo trading bot, we're going to be going over how it works. We're going to actually be going over the back test, because I'm very excited for you all to be able to see that and actually create the algorithm, right? So we can start trading our 0DTE options. But before we get into that, I know option trading could be a bit scary for some, right? So I want to be able to take the time. So the first 10 or 15 minutes, maybe even 30, depending on how I'm feeling, right, of every stream, we want to be able to go over, we're going to call this office hours, in the sense of I want to be able to go over a bit what we're going over today, a little bit of deep dive into option contracts and things like that. Oh, a little bit about me. So my name is Creative, and I've been coding or developing since about April of this year, right? So not too long. And I wanted to be able to bring you all on my journey, right? So you can see my process on how I create different algorithmic trading bots, AI agents, machine learning, things like that. So here at the channel is dedicated to be able to, show you my live coding sessions, right? Again, this is not financial advice. If you do need financial advice, I advise that you do seek that. This is merely educational. So I want you all to be able to see how I do it and how I'm able to use AI agents, right, to be able to build these different algorithms. So if you do have any questions in the process, please let me know. So let's go ahead and get started. So what I want to do is go over, my build, my setup. What I use, I'm using Claude Code, right? And in addition to Claude Code, I'm using Claude Code with inside Cursor, right? And Cursor is a code editor that enables us to be able to create different projects. So I'm using Claude Code, Cursor, and then when I need to flesh something out, we're going to be using ChatGPT. Okay. I mean, I can use, and with side, so I'm using two different AIs, Claude Code, that's Anthropic, so that's your Sonnet. I primarily use 4.5 within Claude Code. So as you can see here, but we're going to get here so you can understand it. So I primarily use 4.5 within Claude Code, and then ChatGPT, any model really suffices. So let's go ahead and go in. What I want to do is just really break down option contracts, the type of option contracts that we're going to be doing. Then we're going to jump straight into the strategy, and we're going to show you the back test that I've created and we ran for both the momentum and the mean reversion strategy. And again, I know some of those words may be a bit foreign, but we're going to break that down and talk about that, what that means, and how we can be able to use that when it comes to creating any other strategies. All right. So again, if you do have any other questions, please let me know. So let's go ahead and get this thing started. So can you please explain, like 12, what is an option contract? All right. So let's go ahead and get this output. So imagine, right? And again, I just explained, I'm in ChatGPT and just put in a simple prompt, right? Can you explain, like I'm 12, what is an option contract, right? So imagine there are a pair of sneakers that cost $100, but you think the price might go up soon. So you tell the store, hey, I'll give you $5 right now if you promise to let me buy those sneakers for $100 at any time next month. The store agrees. Now you've made something that's like an option contract, right? Here's how it works in stocks, right? The sneaker in this analogy is going to be the stock, and that stock will represent Apple, Amazon, Nvidia, AMD, Snapchat, right? We've been primarily dealing with SPY, and SPY is the S&P 500. Now, with regards to the S&P 500, it is the top 500 companies within the New York Stock Exchange, right? Now, the New York Stock Exchange is going to be the older of the two when it comes to, it's going to become, the New York Stock Exchange is the older, was one of the oldest, or is the oldest stock exchange, started in 1791. There's a couple other strategies that we have that we use, NASDAQ and so on and so forth. But right now we're going to be focusing on SPY, right? And in SPY is just the Standard & Poor's 500, S&P 500, right? And it's just the top 500 companies within the New York Stock Exchange, okay? So the sneaker here is the stock, right? And then the $5 is the option price, right? So that's your premium. So the promise for you to pay the 100, right? That's the strike price, right? And next month is the expiration. Now you didn't actually buy the sneakers stock yet, right? You just bought the right to buy them at a certain price, right? So there's two main types of options, right? There's a call option, the right to buy a stock at a set price because you think it may go up, right? And there's a put option, the right to sell a stock at a set price because you think it might go down. So I like these two definitions. What I'm going to do is bring them over to our whiteboard, right? So with our whiteboard, I really hate when it does that. So again, what we're doing is option contracts, right? So option contract equals the right to buy an underlying asset at a set price at an agreed upon time, right? So that's an option contract, right? So it didn't, I just went a little bit ahead because I think it was just going a little bit too slow. But I want to do is make this nice looking for you all. So just give me a second. We're going to have our, so within every option contract, right, there's 100 shares, meaning self-explanatory. So every option contract is 100 shares, right? And there's two main types of option contracts, right? We have a call option, and that's the right to buy a stock because we think it's going to go up. So whenever you buy a call option, right, that call option equals bearish or bullish. What am I saying? Right? Put our little bull here. And again, that equals we think the price might go up. So we can have some contrast here. Let's change the color. I know you can see purple. Let's double check that. You can see purple. All right. So call option is the right to buy, right? Right to buy a stock. Let's go ahead and make this. Can you see? That's probably going to be too light. That's too, that is too light. Again, y'all just bear with me. That's not intentional. I know it's not intentional, whatever. So call option is the right to buy a stock at a set price because we think that it might go up, right? So call option equals bullish, right? That's why we have a little bull here. We think the price is going to go up. Now we have the inverse, right? Now we have a, let me get my bear. We have a put option, right? This is the right to sell a stock, right? Right to sell a stock, right? At a set price because we think that it will go down. So put option equals bearish. Put a little bear here. And we think the price might go down. Right? And let's change our color. Let's just keep it. Boom. All right, so we have our call option. And again, the call option, I'm just going to make this super redundant, right? So we can really, really hone in and understand what we're doing here. All right, so a call option is the right to buy a stock at a set price because we think it might go up, right? And that call option equals means that we're bullish, right? Bullish means we think that the market is going to go up, right? So call option, reason you want to buy a call option is because you're bullish on the market. If you're bullish on the market, you think it's going to go up. So what are you going to buy? A call option, right? So put option is the right to sell, right? And we're going to sell a stock at a set price because they think the market is going to go down, right? So put option equals bearish. Why are we bearish? Because we think the market is going to go down, right? And normally when we're bearish, we're going to buy put options, right? So we're going to go get it. We're going to get into our regime, our two strategies, but I just want to be able to hone this in and just make sure we really, really understand that. All right, let's keep going. So example, you buy a call option for Apple. The strike price is $100. It expires in 1 month. Ours is going to be dailies, and you're going to see why we do dailies. And when it comes to options, there are dailies, meaning that expires the same day. There are weeklies, meaning that expire within a week, right? Or couple, maybe 2 weeks, right? But normally it's a week, right? And there are monthlies, meaning that it expires in a month. Then there are semi-annual. I mean, if you buy an annual option, you better know what the hell you're doing. But those are the different types of option expiration dates that you can have, right? So if Apple stock goes up to 120, you can still buy it for 100. Then you can sell it for 120 and make the $20 profit minus the $5 you paid, right? So if Apple stays below 100, your option is useless. You wouldn't buy it for more than it's worth. You just lose the $5, right? In short, an option contract is a coupon that lets you buy or sell a stock for a fixed price before a certain date without actually having to own it first, right? I like this. Let's go ahead and take that. I mean, I have my little definition here. That's not to say that's not good, but let me just take that one, right? So we can really just start building out our notebook. So option contract is like a coupon. Okay, this orange. Can you see? I know you can see purple. All right. Option contract is like a coupon that lets you buy or sell, right? Buy or sell stock for a fixed price. Let me just accentuate that. So I'm going to change our color. And the reason I'm using purple and orange because I know you can see those. The other colors, I'm still experimenting. I don't know if you can see that as yet. So I'm just going to keep to what I know you can see. All right, option contract is like a coupon, right? That lets you buy or sell a stock for a fixed price before a certain date without having actually to own it first. And remember, with every one option contract equals 100 shares, right? So in our example, all right, so let's just take this example here. So what is the cost of the option contract? Right? Here's our example. Really just like that it does that. All right. So remember, there are one option contract, one option. This whole, I need contrast, right? I really wish that it did it automatically. Like it automatically said, okay, let's do some contrast instead of me having to do it. I hope we get to a point, we can do that. All right, let's keep going. So one option contract equals 100 shares, right? So if it's $5, so options work. So I really should have brought in the bid and the ask. Hold on. Let me explain the bid and the ask. And once we explain the bid and the ask, then we're going to go over like the cost of it. So let's explain. So do we understand that, right? So let's just briefly go over this real quick so we can make sure we're driving this home. So everybody wants to get into option trading, right? So this is in essence your starter course on how to be able to get into it. So an option contract, right? So whenever you think of an option, right, it's like a coupon that lets you buy or sell a stock for a certain price. Now, you may be asking, why are we selling? Okay, let's do that. Why are we selling puts and buying calls? Explain like 12 using an out of the box. You know what I should have done that I folded? And my fault. Let me just zoom in so I know that I know you can see. Zoom in one more time. Let me zoom in just to make sure. Is this blurry for y'all? I don't think so. I think you should be, yeah. Let me just check my levels. So that I know you can. All right. So it's Gucci. So you can see. If it's blurry, let me know and I will adjust. I'll do my best to adjust. It's like you have to be your own producer, your director, audio engineer. When you stream, it's fun. I ain't gonna hold you. It's just these little nuances that you got to get by. So, all right. It is super zoomed in for me, but let's keep going. All right. Why are we selling puts and buying calls? Explain like I'm 12 with an out of the box analogy. All right, so imagine you live inside of a neighborhood full of cool houses. Each house equals a stock, right? Apple, Amazon, Microsoft, AMD, Nvidia, so on and so forth, right? You want to make deals about these houses. Stop. You want to make deals about these houses without actually owning them yet, right? So buying a call, right, is the house ticket for future treasures. You find a house that you think will become super valuable soon. So you have the owner say, "Hey, I'll give you $10 right now." This is almost like real estate, wholesaling, being able to assign a contract. This is explaining it to a T, and we're going to go over that later because I created an AI agent that takes. Okay, let me not do that. Let's stay focused. Let's stay focused. All right. So the buying a call is a house ticket for future treasure. You find a house and you think it will become super valuable soon. So you go to the owner and say, "Hey, I'll give you $10 right now if you promise that I can buy your house for $100,000 at any time in the next month." If the house price jumps to 150, you can still buy the house for 100,000, right? And then sell it for 150. Boom, you just made a quick 50K minus the little $10 you paid for the option contract, right? For that call option contract. That's why people buy calls. They think something will go up soon. If the price never goes up, the $10 ticket that you just buy just becomes worthless. No big deal. You just lose $10, right? Selling puts, right? House insurance company. So imagine your friend owns a house worth $100,000. He's scared that the price might drop. So you say, "Hey, pay me $10 and I'll promise to buy your house for $100,000 if the market crashes and it drops lower." If the house prices stays high, your friend never needs to use the insurance and you just keep the $10, right? But if the market crashes to 80,000, your friends comes to you said, "Hey, you promised, and now you have to buy the house for 100,000." So selling puts is like being the insurance company. You hope nothing bad happens, so you keep the money, right? So recap: buying calls, you pay a fee and right to buy later. You hope that the price will go up, right? The treasure ticket analogy, right? Selling put, right, is get paid insurance for promise. Selling a put, you get paid to promise you'll buy if it drops, right? We're hoping for the price to stay up. That's house insurance analogy. So when we buy calls and sell puts, we're basically saying, I think that the price is going up and I'm willing to collect insurance from people who think that it'll go down, right? So would you, okay. Do we get that? Right. So that's why we buy calls, right? Because we want to be, we're thinking that the market is going up. We're bullish on the market, right? And because we're bullish on the market, what are we going to do? We're going to buy a call option. And that call option is that we're bullish and we think that the market is going to go up, right? Put option, right? We're selling. It's selling the insurance in that analogy, right? Why? Because we're bearish on the market. We think that the price will go down, right? So that's why we're going to get that put option, right? All right. now let's go over option pricing, bid and ask, and how we determine the price and value of option contracts. Then after this, we're going to go over after the Greeks, we're going to go over the strategy, and then we're going to jump right into the back test. So I hope you all are enjoying this. Again, I'm being extremely thorough just to ensure that there's nobody lost throughout this. I don't want to make no assumptions that anybody knows what the hell I'm talking about, right? So that's why I'm being extremely thorough about this process. And once we get to the code, all of this is going to connect, right? All right, so let's keep going. All right, so let's break this down like you're 12. So, stop. So imagine you're at a recess candy market. Kids at your school trade candy coupons, options that let them buy candies later at a set price. And these coupons are like option contracts, right? Bid and ask, right? What buyers and sellers want. So the bid equals what the buyers are willing to pay, right? I'll give you $2 for that coupon. The ask is what sellers want to sell it for, right? I'll sell it for $3. There's usually a gap, and that gap is called the bid-ask spread because buyers want to pay less and sellers want to get more. Example, if the bid is $2, right, and the ask is $3, the real market value is usually around $2.50, where they're usually agree, right? That's the mid. So let's get our bid and ask. I like this. So bid, let's go ahead and bring it over to our worksheet. So bid, let's see. You can see red. So bid is what you're going to pay. And then ask is what you sell it for. Let's see. Let's try blue. You should be able to see that. All right, perfect. And then, so example. Bruh, you just didn't do that. Now you want to. Stop it. Stop it right now. Example is I'll give you $2 for that option, right? Option coupon or that coupon, right? So that's on our example. I don't like that. So bid equals what buyers are willing to pay, and then ask is what sellers want to sell it for, right? Let's keep going. So what makes an option contract worth more or less, right? That's called the premium and depends on many things. So let's use our candy coupon analogy to make it simple. The stock price, the candy price. So if candy gets more expensive in the real world, your coupon, if candy gets more expensive in the real world, your coupon to buy it cheap is worth more. So when the stock goes up, call options go up, and when the stock goes down, put options go up, right? So let's go ahead and grab that. So what we're going to do is we're going to just build on it right here. All right, we're going to make this. Can you see peach? You cannot see peach. What about we try purple? We already have orange. I'm just gonna do black. Ain't nothing wrong with black. All right, and then here we go. I like that arrow, so I'm gonna put that arrow there too. All right, so let's go over this one more time, right? And this is looking nice. We're building out our worksheet, right? So a call option equals the right to buy a stock at a set price because we think that it'll go up, right? So call options equals bullish. That's why we have our bull here, right? And we think that the price might go up. So when the stock goes up, right? When stock prices go up, when stock prices goes up, right? Call options go up, right? So that's one thing to be able to keep note of. Let's underline that. If I can make that a bit bolder, I would. That's fine. So put options, this is the right to sell a stock at a set price. We think it'll go down. So we're bearish when we buy a put option because we think that the price might go down. So when the stock goes down, put options go up, right? So we see that inverse relationship. Stock goes down, put options go up. Stock goes up, call options go up, right? So we understand? Perfect. Let's keep it going. Time to expiration. The longer you have until your option expires, the more time the candy prices have to move in your way. More time equals higher value, more hope. Less time equals cheaper options. Hope is fading, right? Volatility. If the candy prices jump up, move around a lot, sometimes $1, sometimes $5, that coupon becomes exciting and risky. More drama equals volatility, higher option prices. Calm and stable equals cheap option prices. So what they're talking about right there is implied volatility. So let's break this down. So we have IV and we have volatility. Let me make these colors that are a little bit black. So implied volatility, or IV, right, is what the market expects will happen next, right? So this is future, right? Let's go ahead and spell that right. Then we have volatility, right? So volatility, or just volatility, is what the market is what is happening currently in the market. So volatility is real time, right? That looks very okay. Let's try that. And I know we're closer to Halloween. This is not bro. This just happened. Whatever. So implied volatility is what the market expects to happen, right? This is future. This is what we expect to happen in the next 30 days. So when you look at IV, or implied volatility, this is what we expect to happen in the next 30 days, right? So usually, let me put a little asterisk. Usually in the next 30 days, right? So that's implied volatility. Volatility, right, is what's currently happening now. I don't really think you can see that, so let's keep playing around with these colors. Let's see red. I know you can see red. All right. So volatility is what's happening currently in the market, right? Real time. So implied volatility is what we think is going to happen in the next few 30 days, right? So that's future. Volatility is right now, right? So when can we spell? When IV, remember IV is just implied volatility, is high, right? Option prices are expensive. Why? Because the market is expecting a big move, right? And that move can be bearish or bullish, meaning that move can have a positive or negative, let's spell negative impact to the option price, to the option contract, right? So when IV is high, can we not spell it? When IV is high, and that's implied volatility, option price is going to be crazy expensive. Reason being so is because the market is expecting a big move, and that move could be bearish or bullish. Now remember, bearish, right, we think the prices are going to go down. Bullish, we think is going to go up, right? All right, let's keep going. So let's talk about the inverse. When IV, implied volatility, is low, the option prices are going to be super cheap. right? This is what we want. But why? Because the market is calm and stable and expects no big moves, right? Perfect. So high volatility, high IV, options and prices are crazy expensive, right? Low IV, option prices are not common stable. High IV, market is expecting a big move. That can be bearish or bullish, right? So that's what it's talking about here, right? So when it's talking about more drama, volatility, higher option prices, that's high IV, right? Common stable, low IV, right? This is talking about rates and dividends. I mean, we're going to get into that, but you don't need to know. We're going to get into that later. So let's just keep going so we can keep this up. So how prices are calculated behind the scenes. We're going to get into that. You don't need to know that part right now. So intrinsic and extrinsic value. So this is something I want to go over real quick. So intrinsic value is what is the worth right now, right? If you used it. So if candy costs $5 and your coupon lets you buy it for $3, there's a $2 intrinsic value. You see that, right? It costs $5. Your coupon lets you buy it for $3. There's that $2 intrinsic value, right? Extrinsic value is the extra hope or time value, right? Even if the candy is still $3, it might go to $5. So the coupon is still worth something, right? Option prices equal intrinsic plus extrinsic value. So let's go ahead and grab that so we can continue building out. Oh, come on. Boom. Yeah, I'm going to figure out a way that it doesn't do that. That every time we paste it, it just allows us to paste it. And it's like, all right, bet, it's running. So we have the intrinsic, then we have the extrinsic value, right? So I love where we're going with here. We're building out our workbook, right? And this is workbook that if you all want this, I can definitely share, so it can definitely help you around your journey. Right, so we have our intrinsic, we have our extrinsic value. So the option prices equal the intrinsic, right, is what it's worth right now, right? So if the candy costs you $5 and the coupon lets you buy it for $3, there's that $2 built-in intrinsic value, right? Extrinsic value is the extra hope or time value, right? So even if the candy still is still $3, right, it might go to $5, right? So that hope that it might go to $5 is that extrinsic value. So the coupon is still worth something. So that's why we have our intrinsic plus extrinsic, right? All right. Now provide a example, a few of calculating option cost worth using the bid and ask. So we can really get into this. All right, perfect. I'm going to take this, right? And then we're going to break this down. Let's just go over real quick, then I'll break it down, right? So the candy example. So let's say you're looking to buy, all right, man. So let's say you're looking to buy a call option for a candy stock called Candy Co., right? The strike price, and the strike price is what we think, right, that the option will be worth, right? The current stock price is $12, right? So the bid, right, bid equals buyers, right? And we're the buyers, so this is what we're going to pay. But you're going to pay this if you're doing market orders, right? So the difference between a market and a limit order is the market order, you're going to pay the bid, right? Whereas the limit order is like you're going to pay maybe the middle. So let's say you're between like 275, 260, 280, right? So you as the buyer, you can set your prices, right? So that's why when we're building strategies, we're doing limit orders and not market orders. But there are times where market orders make sense and but again, market orders sometimes mean that you're overpaying or you're underselling, right? So you're paying too much and you're leaving money on the table, and we don't want to do that. So that's why we use limit orders. Let's keep going. So when you're buying the bid, again, it's a market order, you're going to be paying the 250, right? And then the ask when you're selling it is in $3, right? So the midpoint fair value, the midpoint between the bid and the ask is what most traders use as the fair value estimate, right? So fair value equals bid plus ask divided by 2. So you do 550 divided by 2 is 275, right? So the estimated cost for one option contract is 275 times 100 equals $275, right? Each option contract equals 100 shares, right? So do y'all want let's just keep going, then we'll really break this down, right? And this is for a call option. So step 2, if the stock is $12 and then the strike is 10, the option is in the money $2, right? Intrinsic value $2, right? The extrinsic value is the fair value minus the extrinsic value is what we paid, the 275 minus the intrinsic value 2 equals $75, right? So 0.75 is the price excuse me, $75 or 0.75 of the price is time value. Hope that the candy price goes up before expiration, right? Example 2, you're looking to buy a put option on cocoa stock, right? The strike price is 50, the stock price is 46, right? Bid is what we buy, or you're looking to buy for it right now, 440, and then the ask is what you're hoping to sell it for, right? So fair value is that you take the bid and the ask divided by 2, so 440 plus 480, right? And then you divide it by 2, you get the 460, right? So one contract equals 100 shares. So we're going to do the 460 times 100 equals $460, right? So the intrinsic value is how much the option is already in the money. Since you can sell it at 50 when it's trading at 46, it's $4, right? So the intrinsic value for this is $4. Is this making sense? Am I going too fast? If I am, please let me know. I'll slow down a bit. Right. All right. All right, let's keep going. So wait, let me check my levels. Check my levels. All right, we're Gucci. So let's keep going. About another 10 or 15 minutes, right? Then we'll jump into the strategy, right? Again, this is all going to tie back into it because I want to be able to build the base. Once we build the base, then we go into our strategy and we'll start having fun with the coding. All right, let's keep going. Right, so then the extrinsic value, the time value, right, is the 460, what we paid for it, right, versus the $4, and that's the intrinsic value is the 60 cents or $60, right? Meaning is the remaining $60 is the time and volatility value. Example 3, more realistic. We have a strike of 500, right? The SPY current price is 499. So the bid is 215 and then the ask is 225. So let's go and find our midpoint. Again, to find our midpoint, we're going to add our bid and our ask and then divide it by 2. And then we get 220, right? So each contract costs 220, so times 100, we get $220, right? The intrinsic value is the 490, right? The SPY currently times the SPY. It is currently out of the money, so you wouldn't exercise it yet, right? Because it is out of the money, the extrinsic value is the 220, what we paid for, minus the 0 because we're out of the money. And I'm going to explain end the money, out of the money in a bit here, right? So all the 220 is time and volatility. You're paying for the possibility that SPY rises above 500 before the expiration, right? So does that make sense? So if you want, let's really break this down a little bit more. So I want to take the SPY one because that's the cleanest one. And we're going to do it a little bit different, right? I mean, yeah. So, boom. Perfect. We already have our bid and our ask explanation up here, right? So a bid is what the buyer is willing to pay, and then the ask is what the seller wants to sell it for, right? We talked about IV. We talked about the difference between IV, volatility, and IV, right? So IV is what's going to happen in the future. Volatility is what's happening now, right? So, boom, let's drop our example. Let's make gang black. All right, perfect. So the strike price, right? This is what we are hoping the current price goes to in order for us to make money, right? So I think it'll behoove us to talk about in the money. So the current price, let's use this example. Current price is $4.98. $4.98, right? So when you're talking about boom, in the money or in the money, or you see ITM is in the money or out of the money, OTM, right? Or at the money, right? ATM. So in the money, ITM, out the money, OTM, right? Or at the money, right? Perfect. So this is what we're going to talk about next. All right, perfect. So our current price is, I don't like that. Okay, perfect. Let's put you there. Okay, follow me, but don't follow me. Follow me now. All right, in the money, right, is ITM, out the money, OTM, at the money, ATM, right? Because you want to print. All right, perfect. So our current price of SPY is $4.98, right? SPY, remember that's the S&P 500, and remember top 500 companies in NYSE. Boom. Boom. Let's spell it right. Top 500 companies in the New York Stock Exchange. Perfect. Thank you. Can you come here? Thank you. Top 500 companies in the New York Stock Exchange. All right. I want it over there. I'm sorry. Okay, my brain just works that way. Okay, here we go. I like this one better. Sorry. So SPY, and SPY is the S&P 500, NP, S&P 500, and it's the top 500 companies in the New York Stock Exchange, right? So the current price is $4.98, right? So remember, calls, this is going to be the annoying part, but let's just go grab it real quick. Grab me an arrow. All right, come on. Show me my arrow. I'll take that one. Thank you. Have a great day. This is going to be an annoying part because this is going to want to move. Boom. Let's make you that. All right, let me just check my levels. Let's make sure we're Gucci. Y'all can hear me. All right, good. Let's keep going. So calls, right? We think the price is going to go up, right? So for me in my house, right, I do 2 levels. Anything. What do I mean by 2 levels, right? So $4.99, that's still in the money, right? 500, that's still in the money, right? This is when I said it was going to be annoying. Can I just lock it there? All right, perfect. Don't move. So anything greater than or equal to 501 is OTM, right? Out of the money. So let's make that black. Let's make this black. So 500 is ITM, that's in the money, right? 499 ITM, that's in the money, right? So for me in my house, out the money equals 2 or more levels up for calls, right? All right, so 501, anything greater than or equal to 501, it is out the money, right? So you can see it takes us 2 levels in order to get there. Now, some people use 3, some people use 5, some people use 10. That's the arbitrary part of it. Like, you use what you're comfortable with, but for me in my house, it's 2. right? So anything 2 levels or more up, right? That's call out of the money, right? And the inverse works for puts. So remember I said this was going to be unlock. No, duplicate. Let's see if you follow me. Boom. Remember, calls, we're going up. So let's put, come on, just follow me. Perfect. So let's put puts, right? Current price is $4.99, right? So puts is the opposite way. So hold on. All right. So again, we're talking about puts. So 498, that is in the money, ITM. 497, that's in the money, so that's ITM. So anything, again, me and my house, anything less than or equal to 496 is OTM, out the money, right? Hold on, let's get this right. I kind of, all right, whatever. Boom. Get you right. Okay, beautiful. OTM equals 2 or more levels down for puts, right? Again, this is me in my house. Everybody does it a bit different. There are some that use 3, there are some that use 5, right? Like everybody uses a bit different. But for me in market, this is really just getting at me. Lock position. I know it's not okay. Man, I'm gonna lock position there. All right, perfect. Okay, this is still bad. Unlock. Okay, just follow me, bro. Just follow me. Okay, I like this better. All right. Lock position. Unlock. I know it's, never mind. Y'all be okay. Go back. All right, perfect. So we got it. So we got the out the money and the money, right? So we understand that. And at the money means you're at 499, right? Or you're, if we have a strike of 501, right? So at 501 we're at the money ATM, right? So we have out the money, we have in the money, right? And we have at the money, that's at the current price, right? So we're good. We can keep going. All right, perfect. And the reason I wanted to talk about that is because, so the strike price equals what we're hoping the price, the strike price equals, this is what we're hoping the current price goes to in order for us to make money, right? So that's the strike price, and that's 500. Why does it look so weird? Because this is just me. All right, don't be weird. All right, current price is 499. I just color code these real quick so we can understand. Bid is what buyer, then ask is seller. All right, perfect. So again, there are 100, one option contract equals 100 shares. So 100 times. Now normally, yeah, you can do their whole equation, do the 250, 215 plus 220, right? What is that? 435. That 435. That's 4. That's 3. That's 435 divided by 2. What is that, like 2? I'm not gonna hold you. 435 equals 2,175, right? You can do that. There's nothing wrong with that, right? And especially with algorithmic trading, I mean, you can definitely set that in where this can be how you determine, and this will be our mid price for a limit order, right? If we were to buy, if we just use the bid, right? This is going to be, if we just purchase the bid, this is going to be a market order, right? If we just use the ask, right? This is going to be a market order, right? And the market order sometimes for a bid can mean, right? Can mean that we are overpaying, right? And for a ask, right, can mean that we are underselling, right? Leaving money on the table, right? And here, making the market maker richer. Why? Why? Why we want to do that, right? And remember, market makers are going to be the ones who primarily sell the call options. I wish you could point a little arrow and just type up here. I just need something flash in front of me. Never mind. So market makers are going to be the ones primarily when you're buying call options, you're going to be buying it from a market maker, right? So a market maker are going to be the ones when you're buying a call option. They sell put options, but primarily they sell call options. So market makers are just individuals to make sure that there's always buying and selling going on, make sure that there's always available options going on, right? And market makers are not just for one underlying asset. The market makers are in every option contract, right? And maybe we'll dive into that a little bit later, but you need hella money in order to be a market maker for this. And it's kind of expensive because you can get caught with a gamma squeeze, right? And we can touch on that later. But again, if we do a market order for a bid, we can be overpaying. We're making the market makers richer. Why we want to do that, right? Unless we're the market maker, somebody wants to pay us a market order. Yeah, I'll take it, right? And an ask, right, can mean we're underselling, we're leaving money on the table, right? Why are we doing that? We spend all this time to be able to get here. Why not cash out, right? So when we do it this way, right, this is going to be how we do a limit order, right? So it'll be the 100 times 175, and that equals $217.50, right? So this is our cost. This is what we paid for it. This is what we paid for the option. And this is why I dislike that example, because you see where these arrows at now? All right, for right now, what I'm going to do, boom, I'm going to keep these arrows on the side. And then when I need them, I just go grab them. Because I'm just not going to do that whole, and I'm going to lock y'all right here. When I need you, I'm going to grab you. Kind of looks cool, but I need you. If I could just hit it, oh, go up, go down. But I need you, I'm going to grab you. Let's leave it right there. All right, so this is what we paid for the option. I'm just missing an I, right? So when we are ready to sell, right? Now, you could do the same thing, right? But what I'll say is that, all right, let's just say we sold it. We bought it for $217, right? So let's just say for the purpose of simplicity, we sold it for $220, right? Let's make a little bit of money. We sold it for $250, right? So we're going to do 100 times 250 equals $250, right? So what is the P&L? And that's profit and loss, right? So we bought it, remember, for, if I could write, $217.50. Let's make this red because this is a debit. We're going to accounting class. Have you ever taken that accounting class? Your debits and your credits, and you have to be able to reconcile your account. Boy, I hated that. So that's your debit, right? Remember, bruh, just taking me back. All right, whatever. Do we have our credit coming in? That's our, because we sold it. All right, just follow me, bro. Follow me. All right, let me just put it here. Because we sold it, right? So then we have our credit coming in of 250. It wouldn't be red because it's a credit, right? So now our net equals, right? Subtract 250, $32, right? We just made 32.50. Hip hip, right? So this is our net profit. Let's see if no, let's just do what I know you can see. So this is our net profit, right? So you see how we went to be able to calculate that, right? So we understand how to, so what we did is we understand options, right? We understand that there's one share in every option contract. We understand the extrinsic and the intrinsic. We understand how that gets to the option price, right? We understand the calls and the puts, the bid and the ask. We talked about volatility and implied volatility, right? And we just went over how to calculate the option price. Then we talked about in the money and out the money, right? So now let's get to the fun stuff, right? That took a little bit longer, but that's fine. You all are aware. Now you understand. So let's talk about our strategy, right? Our strategy, and what I'm going to do is, let me take this and I'm going to have it broken down super, super simple. Review our current option trading strategy and explain to us like we are 12 years old so we can truly understand it. All right, so let's go over our strategy. So we have MEANIEBEAR. MEANIEBEAR is our momentum / breakout strategy, right? So whenever you see that word momentum or breakout, what are we looking for? We're looking for the price to go up, right? We're looking for it to break through the resistance, right? I had a dope little picture. Hold on. Where is it? Give me a second, and this will explain it. Hold on. You know what I can do to find that quicker? I'm gonna go here. Perfect. Where can explain support and resistance? Perfect. Come here. And then are you gonna open? All right, beautiful. Right? So resistance is the top. So this is the stock price, right? So this is a stock, let's just call it, this stock was moving intraday, right? So the resistance is the top of the stock price, right? Is the top where we want to be able to sell it at, right? So what we're hoping for is that for momentum breakout strategies, right, is that the stock price, right, breaks through the resistance level, and the resistance level is just the top of the stock price, right? So let's say if the stock price was 500, the resistance level will probably be like 505 or 510. Now normally people like to use for resistance level is the past. Now this is arbitrary part. Arbitrary meaning you can use whatever fits for you, but for me in my house, right, sometimes it'll be 24 hours, sometimes it'll be 5 days, sometimes it'll be 30 days. The resistance level all will be predicated on the underlying asset, right? So resistance equals a roof, right? So whenever you have a breakout momentum strategy, you want to be able to buy once it pushes past the resistance, right? Reason being so is because, all right, it just made new highs and maybe it's going to continue there, right? So what we're looking for is signals that we're buying probably here or even here or sometimes even here, right? So if we're buying here, right, and this we just bought the low and we had signals that you're always about to bust through this resistance, right? Pause. Then we're going to catch it and catch this little wave and then sell. And we don't multi-trade, right? We're doing one trade a day, because I've noticed that if you allow the robot to do 2 trades or 3 trades, sometimes it'll do revenge trading. And what revenge trading means is that, revenge trading would mean is that sometimes you would have a loss, right? Or you do have a loss, right? And with that loss, you want to go make it up real quick. So I don't want that. I'd rather just take our L, learn the lesson, and then move on to the next day rather than just trying to make up for a loss. I'd rather, okay, let's understand what happened. Let's recalibrate a bit and let's move on to the next thing. Got it? So whenever you have a momentum breakout strategy, you're looking to be able to catch it making new highs past the resistance. And then support is the floor, right? So the support is the floor. All right. So I'm going to come back to that. So let's keep going. I ain't want to cough in your ear. All right. Let's keep this thing rocking. So, where am I? A momentum breakout strategy. So I just talked about that. So think of this like think of this like riding the fastest kid in the playground. Think of this like riding the fastest kid in the playground race. When one kid suddenly takes off and starts running faster than anyone else, you jump in and run with them. So you're betting that they keep going, right? So what this means is that we're using a 5-bar price breakout, right? Let me show you an example. So when you're looking at, and this is trading view, right? And where you're looking at any stock, every bar indicates a time frame. And what we're doing is that each candle or bar, I'm going to call it a candle, right? So each candle represents 1 minute, and that denotes it here. And what we're looking at is SPY. Remember, it's the S&P 500. So each candle denotes 1 minute. And for our strategy, what it's taking is doing 1, 2, 3, 4, 5, right? It's looking at these past 5 candles in order to determine, all right, is there a breakout within these past 5 candles? It's not only looking at the candles, but it's also looking at the volume surge, right? So there has to be 103% volume surge plus within these past 5 candles, we're looking for a breakout. And remember what breakout is saying is that I'm looking to make sure that we're pushing the resistance. If we're pushing the resistance, then we have a breakout on the rise, right? But if we're just, all right, it's just touching the support, touching support, touching support, touching support, that's really not a breakout, right? That's more so a mean reversion strategy. We want to get at that. But a breakout strategy is saying that, all right, it's pushing the resistance, it's pushing the resistance, it's pushing the resistance. Let's go for the ride, right? So that's a breakout strategy, right? So our breakout strategy is looking for a 5 price breakout, right? So it's looking at the 5 bars plus 103% volume surge, right? So you're watching 5 laps of candles. If the stock suddenly breaks past the highest lap, our resistance, right, with more cheering, 103% volume, right, then your go, right? That means we're going to go in. Right? So we buy calls on the upsides of the breakout and puts on the downside of the breakdown, right? So if the stock breaks up, you buy a call, you think it's going to keep going higher, but if it breaks down, we buy a put. So it's there's no directional bias, meaning that we just don't buy calls, we just don't buy puts, we do anything, right? So this is a trending market, meaning that, so VIX, we didn't talk about VIX yet. All right. This is what I'm going to do for you, because I have this and I want you to understand what VIX is. All right. So I'm just going to explain what VIX is real quick. So VIX is a volatility index. So VIX tells us how scared, right, or how volatile the market is. Remember, we're talking about that before? So the difference between VIX and implied volatility and volatility, right? Implied volatility and volatility are option specific, meaning that every option contract is going to have different volatility. Okay, I just noticed something. Do I need? Okay, never mind. I'm just tripping. I'm tripping. I thought I seen something. Excuse me. So implied volatility and volatility, right, is option contract specific, meaning that, excuse me, every option contract, even damn near every different strike price, right, is going to have a different IV level and volatility levels, right? These are option contract specific. When it comes to market specific volatility, right, we're going to look at VIX, and there's VXN, there's SPY, there's Russell. There's a lot that you can look at to be able to understand what the volatility of the market is. But normally, right, people come and look at VXN. Excuse me, VIX. VXN is on NASDAQ. VIX is on the New York Stock Exchange, right? So VIX is our volatility gauge. So what is that telling? Goodness gracious, can I not talk, bro? What's that telling us is that, hey, we expect, and VIX of 6, so let's talk about the ranges. So VIX can range anywhere between 0 and the highest I think I've seen it was like $80, but that was stupid high. That was back in COVID, right? Where everything was elevated, and it was kind of weird. I have the strategy that I want to show y'all like during COVID backtest, and it performed extraordinarily well, right? And I was pleasantly surprised. So let's keep going. What am I talking about? VIX. So the VIX levels could be anywhere between 0 and the highest I've seen it was like 80 plus. There's like 85, 90. I think the highest was like 85, 90, or it was like 80 something, right? And this was back in 2020, 2021, COVID, right? So with the VIX right now of 10 to, let's call it 16, let's call it 15. VIX between 10 and 15. Some would say 16, 17, depending on the strategy, but let's just call it 17 right now. VIX between 27, let's call it 10 and 15. Sorry. VIX between 10 and 15, those are calm, stable markets, right? Those are markets that we're not expecting that much volatility, right? IV is going to be low, right? Volatility is not that going to be low. It's going to be low, right? Reason being so is because we're not expecting that big of a swing. But anything above 16 to like 22, 24, I'm going to call that elevated, right? Not really high VIX, but elevated, right? Elevated is that, okay, we're walking on our toes, working on eggshells. Like, we're not really scared. We ain't really scared of nothing yet, but like, we are, like, I'm aware. I'm looking over my shoulder every time I'm walking, right? I'm like, all right, who's behind me? Who's around? What's going on? Right? So anything anything between 16, 23, 24, right? Elevated, right? Anything past 25, put your seatbelt on, right? We are getting ready for a ride. That is elevated levels. We're expecting a big swing. And at times, right? Not always, but like 75, 80% of the time, VIX and SPY has an inverse relationship, right? So when VIX is up, SPY is down. When SPY is up, VIX is down. But there are times, I think last year, August, or earlier this year, we saw that VIX was helping SPY. So it's not always the case, right? But normally, right, when you see VIX popping, SPY's dragging. SPY's popping, VIX dragging, right? So there's that inverse relationship between the two, right? So the reason I wanted to say that is because our strategy is a trending momentum, right? Remember, momentum, I'm looking to push past resistance, right? And anything less than 25, right, is perfect for our MEANIEBEAR side of our strategy. And MEANIEBEAR is momentum breakout. That's why I did MEANIEBEAR, right? I wanted MB, but I didn't want to be basic. So I just did MEANIEBEAR, and that's momentum breakout. Right, so MB, MEANIEBEAR, momentum breakout strategy. Follow me, but don't follow me, but follow me. All right, so anything beyond where am I? Oh, trending market, VIX at 25. It works best for everyone. It's calm, prices are smooth in one direction, right? Not too scary, not too jumpy, right? So MEANIEBEAR is our momentum breakout strategy. We're looking for calm, not too scary, not too jumpy markets, right? And then our TP, or our take profit levels, is 100%. And I know that may sound crazy, but when you're talking about same day options, right, shit can move in your favor very, very fast. So that's why you want to be able to have these stretch goals. I do also have a smart goal within there, right? So it's just not, all right, bet, turn $10 into 20, right? No, right? Is that 50%? What's 100? What is a 100% return on $10? Is that right? Oh, it's $20. Okay, so I was right. I thought that was 50. Oh, 50 is 15. 100 is that. Okay. Follow me, but don't follow me. Follow me. All right, so you take profit whenever you double your money 100%, or you quit when you lose 35%, right? And we don't stay longer than 12 minutes. That's what I love about this strategy. We're in and we're out. We're in and we're out. And you'll see it during the back test. We didn't talk about Greeks yet, but like quickly, let's go over Greeks, right? Delta, there's many Greeks when it comes to option contracts, right? And bro, I had this phenomenal little explanation from a little Greeks, and I think it's here. And this is another one of our strategies, right? But I want to talk about Greeks real quick, and I already have it here. Hold on. Let me talk about Greeks. That's VIX. I already talked about VIX, so you know VIX. You already talked about IV. You know IV. VXN, you don't need to know that right now. Bruh, where the Greeks at? I mean, I could hold it down, but if you can give me a little visual cue, that would be beautiful. EMA, we talked about that. We talked about the little gamma squeeze. You'll need to know that here. I'm sorry. Early thought this was going to give me the Greeks. Option Greeks. Shit. Sorry. Greeks. I know I have an explanation here. That's why I don't want to type it out again, because I know I have it. Boom. All right. Explain option Greeks like 12. Let me just get it up real quick, because I know I had it, but I can't find it. So let me just get it up real quick. All right, so delta is the gas pedal. Delta tells you how much the option price is going to, so let me just read it. So what it does, it shows how much your option price will change if the stock moves up $1, right? So analogy, delta is the gas pedal. It pushes a little, push it a little, and the stock price goes up $1. Your option, your car, right, goes up in that direction as well. So example, delta of 0.5 goes up $1, your option goes up $50, right? So I want to break this down because we are going to need to understand delta. No, let's go here. All right. Boom. All right. Got my little Greek too. All right. So what delta tells us, so delta equals the POP, or probability of profit, or tells us how much, see, tells us, see, boom, tells us how much the option price will change if the stock moves $1, right? I don't like this analogy here, so I'm going to take that out. I think that confuses you for no reason. So if delta is 0.5 and the stock moves up $1, the option price will move up by 0.5. So let's talk about that. Remember, there are 100 shares in one option contract. So that 0.5 equals $50. So what this is telling us, for every positive, because I just want to tell you it's going to be negative too, but it is every positive or negative $1 movement, the delta for this option contract will move the value, the delta for, excuse me, I'm making this more. So for every $1 movement, this option contract will gain or lose $50. All right. Or delta is telling us that this has a, remember back in school, if we wanted to change a decimal to a percentage, we multiplied it by 100, right? So this is POP is probability of profit. So POP is probability of profit. So Delta's telling us that if this stock moves up $1, we're going to make $50 in our option contract, because remember, there's 100 shares in one option contract. And this is also telling us that we have a 50% chance of being able to have this option expire in the money, right? Remember, in the money, right? This is where we want to be able to in the money, at the money, in order to make our money. Out the money is no good, no bueno. In the money, ITM is good, right? Out the money when you're buying, but when you're selling, you want to be in the money. Make sense? Unless you're talking about spreads, but that's something completely different. All right. So gamma, right, is how sensitive your gas pedal is, right? So what it does, it shows how fast delta changes when the stock price moves. So gamma is like, So gamma is like how sensitive your gas pedal is. A small push can suddenly make the car zoom faster, right? Example, high gamma, your option prices react more quickly to the stock price, right? So theta is the clock, or the time erosion. It measures how much your option loses every day just because time passes. So theta is the ice cream melting in the sun. The closer it gets to expiration, the faster it melts. So that's why we only hold our strategy for 12 minutes. All right, let's keep going. So a theta of negative 0.05 means that you lose 5 cents a day, even if the stock doesn't move, right? Vega, what this does is shows us how the option price reacts to the change in volatility, how wild the stock moves. So Vega is like the weather forecast. Stormy days make your option more volatile, more valuable. Calm days make it cheaper. So for an example, a Vega of 0.10, if volatility rises by 1%, the option prices rises by $10, right? Rho is the interest rate sensitivity. What it does is shows us how the option price reacts to the interest rate changes. So Rho is like the cost of renting a car. If the rates go up, some options get more expensive. Rho 0.05 means a 1% interest rate change can increase prices by $5, right? Extra tip, call betting price go up and puts betting price to go down. Having different signs for Greeks, they're the three most we're going to be using delta, gamma, and theta, but so that's so you can understand the Greeks, so we can talk about our strategy a little bit more. Okay, all right, perfect. Stop. All right, so we talked about our delta, right? So we're looking to buy our option anywhere between $10 and $35, right? And we have anywhere between a 10% and 35% chance of this option being able to expire in the money, right, in 12 minutes. Reason being so is because we're buying these options out of the money, right? So it's 2 more levels. We're buying super out of the money options, and we're wanting them to go in the money or at the money, right? So that's why it's $10 or $35, right? You pick the option that moves a little bit, and when the stock moves, not too much and not too sleepy. So playground terms, you see kids sprint out of nowhere. You think the kids are fast. I'm betting they'll win. So you jump in and run with them. Calls if it's running up the hill, put if running down the hill. But if the trip slows down or slow down, you bail. You're not trying to stay in the whole race. You just want that hot moment, right? Fade bear, right? And this is our mean reversion strategy. This is the opposite, right? Now you're watching kids sprint too hard and you think, hey, they're going to get tired soon, right? So you bet that after a big move, things will be calm and reverse, right? So mean reversion, if we're looking at our support and resistance level, right? Mean reversion tells us that, all right, it just blew past support, right? But we know that everything must come back to an average, right? And let's call this zone the average, right? Let's call this the MR zone or the mean reversion zone, right? So it just blew past support. Oh, excuse me, blew past resistance or blew past support. So either way, because we bet either way, right? And we know that it's going to come back to the average. So what mean reversion does is that if it blew past support, we're buying puts because we know it's going to come back to the average. But if it blew past, if it blew past resistance, we're buying puts because we know it's going to come back down. But if it blew past support, we're buying calls because we know it's going to come back up, right? So again, 3 bars, so 3 candles, whereas mini bear or MB mini bear breakout, momentum breakout, is using 5 candles. Our mean reversion MR fade bear, right, is using 3 candles plus a reversal of 8%, right? So you watch 3 candles, and if the stock jumps or drops too much over 0.08%, then you start slowing down or turning. That's the momentum, right? We buy puts on rally fades and calls on drop fades, right? The market chop, we're looking for anything VIX, you see. We have 2 different distinct strategies. So we have market regime specific strategies, right? And I said I wasn't going to go back here, but I want to explain what a market specific regime strategy is so we can understand that. Bruh, I get it, bruh, I get it. All right, here we go. So we have a market regime dependent strategy. So the strategy works when a market is in a particular mood or state, high volatility, trending sideways, right? You detect the state of the market, then you trade, right? A market agnostic strategy is a strategy that tries to trade regardless of the market state, right? You don't rely on detecting the market regime. You trade the same way, whether the market is calm, volatile, trending, or bouncing. This is how you could lose your ass, right? If you don't know what the hell you're doing. So that's why I would recommend the market regime dependent. Our market regime dependent one is how we are building our strategy. All right, so let's go back here. All right, we're going to jump into our strategy. Don't worry. I'm going to, like, this other part is going to be, oh, hold on. Nope. Where is it? There it is. All right. So fade bear, remember we're looking at 3 bars and then the reversal. The direction, we buy puts on the rally fade, calls on the drop fade. We only trade bear markets or high volatility, right? Our TP ranges are a lot less and the delta ranges are a lot less as well, right? So a quick analogy in playground terms, we jump in, we grab quick profits and we bounce back and we get out before the chaos starts, right? So M bear, our momentum breakout strategy, market type is calm and trending. Mindset is we go with the move. What you're betting on is the sprint keeps going. Analogy, the kids are running fast. Fade bear is choppy and scary. We go against the move. The runners are getting tired. I bet they'll slow down, right? Risk is risky and fast, right? So mini bear, we go with the flow when it's smooth. And then fade bear, we bet on the bounce when things get crazy. All right. I think that's enough talking. Let's actually go to the code, right? Again, this is fade bear and we have mini bear right here. So fade bear, again, all of our strategies, we want to start with $100. Reason being so is because we want to dispel the notion that you need thousands upon thousands of dollars in order to start option trading. Now, what we're doing is a very specific type of option trading, meaning that we're trading high liquid option contracts. And what liquidity means is that you can easily buy or sell it without having to worrying about, okay, I'm holding this bag and I don't know if somebody's going to buy it for me, or I don't know if I'm able to buy any, right? So liquidity means that there's always somebody in the market willing to either buy or sell, right? So we want to be able to bet or option trade when we're starting with $100 with underlying assets that have high liquidity. SPY, high liquidity. QQQ, high liquidity. IWM, high liquidity. We'll get to those individual Apple and Tesla. I have a couple of ideas I'm going to try out with that, but for right now, we're going to be starting with the SPY, and SPY is the S&P 500. All right. So remember, this is 0 days. Let me just bring up. This is a little bit better. This is our 0 DTE mean-reversion strategy, right? We have a VIX filter, right? And this VIX filter, right? Because if VIX is less than 25, we don't trade. Right? If VIX is greater than 25 and 50, this is when we trade, right? And we only trade between 9:45 and 11 a.m. Starting capital is 100, right? This is single leg OTM, out the money. Remember OTM, out the money options, and that expire the same day. So we don't hold onto options past 12 minutes, right? This one is 12, and I think MEANIEBEAR. Okay, MEANIEBEAR is 12, and then FADEBEAR is 15. So we don't hold past 15 minutes, right? We're in and we're out, right? So now let me show you a live back test. So we're going to be running our back test. We're going to be running it on 2020. It'll show us once we run it. So let's go ahead and run our back test for FADEBEAR. And what a back test is taking our strategy and then testing it on historical data to see how well it performs. Now, there's a caveat. If the strategy performs well in the past, it means it can do well in the future, but there's a caveat. Just because something does well in the past does not guarantee the performance in the future, right? So what we're doing is that we're training this algorithm to be able to recognize certain signs within a market. And then once it understands it and once we're satisfied with the result, then that's when we proceed to the next steps, right? So what we're going to do is we're going to, let me make sure, because I think it may be on hold on, give me a second, because I think 2025. Okay, no, what I'm going to do is we're going to do 2024 and then 24. Perfect. So we're going to do 2024. Perfect. Let me save. All right. Now let's run our strategy. And again, back test, we're testing it on historical data in order to see how well our strategy does. That is MEANIEBEAR. I didn't ask you for MEANIEBEAR. I asked you for FADEBEAR. Please listen to me. Please listen to me. Again, all of our strategies start with $100. We're testing it on 2024. So you can see 2024 was a bull year, right? VIX was anywhere between like 18 and it was elevated, right? Or excuse me, low. VIX was low. Bull years are normally low VIX, right? So 2024, that's great. And low VIX is, remember, good for MEANIEBEAR. But I want to start out with the bear strategy, and then we're going to go to the bull strategy, right? So I'm going to test 24, then I'm going to go to 22 because I know 22 was a bear year, right? I remember bear where we think the market is going to go down, right? I was about to say bears were bearish on the market, but it's already in the name. So bear, we think the market is going to go down, and that's why 2022 was a bit of a bear year. So the reason it's taking a bit long, you try to do something 193 times and tell me how long does it take you. You try to do something 10 million times and tell me how long it takes you. So it's loading all of our data. Oh, I should have talked about that. So when it, okay, see, it's skipping all these days. Market specific, right? If it's not greater than 25, I don't trade. And it got into one trade, right? We lost $27. So it just did one trade, lost $27, right? But this is a market, that's funny, and did it on the 8th, right? So this is, it doesn't trade bull markets, right? So let me show you a bear market. 22. All right, let me show you a bear market and let me show you what it does. Again, what's happening, and while this is loading, we had to create our own back test. Reason being so is because I tried to use backtesting.py trash for option trading. I tried to use backtrader trash. I tried to use vector.bt trash. I tried to use pi alto trade trash. I tried to use vector bt trash, right? So I'm coming to say is that you had to create your own. And I did this on one episode, so I'm going to, if you all want to see this again, just let me know and I can show you how I did this. But I had to create our own little backtesting library for option trading. So we'll get there. So the backtest is running. It's running on 2022. And I'll wait until the end, and then we'll pick a trade out on random, and then we'll go over it. And remember, all of our strategies start at $100 until said otherwise, right? So once it's done, we'll review one trade at random so we can go over that and talk about what it did, how it done it. And then once we're good there, then we're going to go start. I want to take a quick little intermission. Then we're going to start with building our bots using AI. So I know I took a little bit more time with being able to explain everything, but I'm okay with that because I wanted to make sure that you all really really understand what we're doing here, and there's no second guessing. So I'm waiting for the back test to run. We're running the back test on fade bear. Remember, fade bear is our mean reversion strategy, and this strategy enables us to be able to bet when markets are in bear, right? High volatility, right? So we started with $100, right? It traded 73 times. The final balance was $5,000, right? So imagine if you have an investment, right? And again, this is not investment advice. If you want investment advice, please seek a financial advisor. This is merely educational advice. All right, let's keep going. So imagine if you had an investment, right? And you traded 73 times in a year, right? And it was able to start at $100 and it was able to get to 5,000. How would you feel? Right? So that's 5,000% return. That's crazy, ain't it? Now, there's a couple of things we have to be able to look at, right? So the peak value, it was able to get to 5,542 and 87 cents. So when it peaked, that's when we finished. So perfect, right? Let's look at, okay, so let's talk about the drawdown. Let me talk about the drawdown real quick. So what the drawdown is saying is that at one point in time, I'm going to round this up to $40 so you can understand. So at one point in time, the strategy dropped down to $60, right? Now, hear me out. Now, this is how you got to take the emotions out of it. So that's why I like algorithmic trading, right? Because I'm taking the emotions out of it. I know that I back tested this strategy. I know that I walked forward this strategy, right? I know that I paper tested this strategy, right? So I know that we extensively did the work that we had to do to this strategy. So being able to take our emotions out of it, it shouldn't be hard because we understand we did the work already, right? So at one point in time, the strategy dropped down to $60. What are you doing? Are you going to be the one to say, okay, you know what, just let this ride, right? Or are you going to say, okay, you know what, I'm panicking, right? So what are you going to do in that respect, right? For me in my house, I know the work that we did, right? If we would have pulled out and just took our little $60, bro, we missing out on $5K, right? So take the emotions out, right? Learn your little lessons. That's why we don't overtrade. There's 250 days in a year, right? 250. There's about 252 trading days in a year, give or take, right? 365, I know, but give or take about 252, about 270 trading days in a year, right? And we're only trading 73. Out of those 73 trading days, we were able to make $5,000 and started at 100, right? I like that. I like that. And this is our mean reversion strategy. So we can quickly move on. This is our momentum breakout strategy, MEANIEBEAR, right? Again, it's starting at $100. I just want to check what year we're running before we get started. Hold on. 20. Do I want to show y'all COVID? I'll show y'all COVID after. Let's do 2024. D24. All right, perfect. So let's go ahead and do 2024. And this is our MEANIEBEAR, and this is our mean reversion strategy. And with our mean reversion strategy, again, it's going to take some time because what it's doing, you try to do something 10 million times and tell me how long it takes you. But again, with our mean reversion strategy, remember, it's looking at the past 5 candles, right? And then we're trying to see if they're a breakout within that past 5 candles. Are we touching resistance? How many times are we touching resistance, right? If we are, it's like, do we have the volume to be able to find it? Meaning, I just don't want to, basically, I don't just want new highs, but I want the volume to be able to confirm that, right? Once we have the volume to be able to confirm that, then we can break out, right? Then we can start triggering these strategies. So again, starting capital, so you can see, is $100. Total trading days is 252. So let's keep going. Oh, I know I said I was going to break it down, but I ain't pressed for time. The Finns do play today, but I'm not rushing to that game. I'll watch it, and y'all may hear me talk a little bit as it's going, but I ain't not rushing to that game. All right, we're running our back test, and this is our this is our momentum breakout back test. And with this momentum breakout back test, we're running it on 2024. and to be able to gauge the results, right? And then once it's done, we're going to review and see where it's at. So it started at $100. We are at 2,000 right now, and it's March, bruh. It's March. So let's see where the strategy goes. Again, this is not financial advice. If you want financial advice, please seek a financial advisor or see if that's the biggest trade I've seen so far. One trade, this is true breakout shit. Now, hear me. We got in a call and we bought that call for $35, right? There is a 25, I'm going to round up, it's 24.6, but 25% chance of us being able to make money, right? So we bought it for $35 and we sold it for $73. This happened in 2 minutes. We made $1,000. But all right, let's keep going. Let's keep going. Let's keep going. Let's keep going. Oh, and another thing I want to be able to point out is that this strategy compounds contracts. What do I mean? Is that once we can afford it, we can buy 2, 3, 4, 5 contracts up to 12. Cap is 12 because I noticed that anything above 12, you just fucking around with money, right? You don't know how to handle that yet. And I haven't gotten to the point where I can create an algo that can consistently trade 12 contracts past $10,000 dollars, that is. So I just cap it at 12 once we get to that 10K mark, because then you playing with real money, bro. It ain't play no more. Right. Just so we have 42K. The highest I've seen was 42,000. This is started at $100. This is not financial advice. This is merely educational. All right, waiting for it to finish. We're at 41,000, right? We're in August. We're at 41,000. That's crazy, ain't it? All right, this one, let's just look at this contract real quick. This was a put, 557 strike. The delta, and remember, puts are going to be negative because we think it's going down. So whenever you see a negative, don't be shocked. For delta, you're going to see negative for puts, right? So we got in at $45 and we doubled our money. That's crazy, ain't it? We got in at 45. Okay, this is tripping. It's tripping. Okay. I don't even want to say the number because y'all gonna think I'm bullshitting. Yo, fam. This is astronomical. This is mind-blowing. This is like, what? Again, I cannot wait to paper trade this baby. We're going to be paper trading this live tomorrow. So if you want to see this, be sure to come follow us. I don't know if I'm going to be here or on Twitch, but nonetheless, I am going to be paper trading this live. The highest I've seen the strategy was at $84,000. This is not financial advice. This is educational. This is educational. And it haven't dipped under 75K. It's still holding strong. The highest I've kind of seen it, and I was like, I had to pull back because the shit didn't make sense. Right? It went from 100 to like 177,000, bro. All right. So we ran the back test. We did remember there's 252 total trading days, right? 252 total trading days out of 366, 360, depending on the leap year, right? We traded 169 times. The final balance, and we started, and I showed you, let me show you again, so it's not Capiana. Starting balance is what? $100. Right? So we started at 100 and we back tested it on 2024. And if you think it's cap, I can show you 23. We did 169 trades and we were able to get what? $86,496.65. Let me say that again. We started at $100 and then we got to $86,496.65 return. That is an 86,000% return. That's okay. That ain't that bad. That ain't that bad. You see me? All right. Max drawdown is a little bit better, right? At one point in time, the strategy went from $100 down to, let's call it 35, so we can round up 65. So it went from $100 down to 65. Are you going to panic at that point in time? Are you going to say no, exit, exit, exit? Right? No, right? So the strategy went from $65 to 86K. That's kind of okay. Right? We did 129 trades. The win rate was 58%, right? Best trade was $5,232.91. Worst trade was $1,817.09. The average trade was $512. The average hold time was 10 minutes. The rate of return, 124%, and the profit factor is 324. Meaning for every $1 we point out, we getting 3 back. And for every $1 you put out, we getting 3 back. Type shit. So we ran our back test for our fade bear. We ran our back test on our mini bear, right? So what I'm going to be doing, I want y'all just to give a bit. And when I come back, we're going to be working on using AI agents to actually create our bots now based off these strategies. All right, let me check my levels. I appreciate y'all patience. Oh, let me just get this ready, because let me see how they gonna disappoint me today. I don't think. I'm gonna be optimistic. While I do that, let me just have y'all look at our bot. I have another bot, and this is how I'm going to create. I'm going to use this as a reference, right, to create our meanie. We're going to be creating two bots using AI. We're going to be creating our meanie and our fade bear, right? Our mean breakout, momentum breakout, and then our mean reversion. And we're going to be using this as a skeleton. So just look at this real quick. Hold on. And I had to just check my fantasy too. All right, the fantasy is looking good. I'm not gonna hold you. I'm in 4 right now. 2 of them, not so much. The other 2, holding it down, holding it down. Don't be that guy. Thank you. All right. Let's go. Let me find the Dolphins. There we go. All right, my fins are up. So, what I need to get? I need to go grab. Hold on. I need to grab our IBKR. And again, I'm using IBKR as for paper trading and live trading. So let me go grab IBKR. Bring that over here. What else you need? You already have Alpaca, and Alpaca is how we get real-time prices. So you already have that. What else do I need? What else do I need? Printer. You have IBKR. You have that. Oh, you know what else I need is the position tracker. Let me bring in our position tracker. So here's our position tracker. And I'll explain this in a bit and why we have one. IBKR does have one, right? But for our bot, when it comes to paper trading and live trading, paper trading specifically, live trading not so much. The account balance in IBKR is a lot bigger than what I want the bot to trade with, right? So that's why I created this ledger or this tracker, right, that uses IBKR for validation, but the bot mainly uses this when it comes to being able to track the trades. Reason being so is because IBKR, I think it starts at $1 million, right, for paper trading, and I don't want the bot to see that. You only have access to $100 and trade accordingly, right? Because I noticed that before, when I didn't have this, it would use account balances more than 100, and that's not validating our strategy, right? So back testing is we're using it on historical data. Paper testing, paper trading, right, is we're using it on current data. So tomorrow, and maybe from like Monday, Tuesday, even Wednesday, we're going to be paper trading. Depending on the results, I may even live trade starting on Wednesday. So we're going to be paper trading, and I have 3 bots that I need a paper trade Monday, Tuesday, Wednesday. Depending on the results of the 3, I'm going to take one of them, maybe 2, and then live traded here with you all. So that's why I have the tracker here. So I'm using Claude Code. So what I want to do, I've already, and the way that I like to use Claude Code, right, is to treat it like we're in a deposition, meaning that I know the answers to the questions that I'm asking, right? So what I did was build reference. I was like, all right, I need you to read our momentum breakout strategy, right? And then explain the momentum breakout strategy like I'm 12. So I'm not going to bore you all with this again because we just spent an hour or so being able to go through that. So I'm not going to go through that again, right? So it did that. Then I was like, all right, I need you to do the same thing for, I needed to compare something. So Don't have to worry about that part. Then I need you to do the same thing for our mean reversion strategy. So it did the same thing for the mean reversion strategy. It looked at it, and it was able to properly compare, and then provide me an explanation, right? Oh, and we're getting the ball first, bruh. All right, so this is the so it knows both strategies. It knows the mean reversion, right, and then it knows the breakout strategy, right? So it knows both. So now we can actually start the work when it comes to being able to use artificial intelligence or AI agent, right, in order to build. Now there's this cool feature. I guess let me show y'all now. So Anthropic or Claude Code has this feature where you can create agents, right? So let me do that now so you all can see how we're going to create it. So again, you saw how I did that. So you're just going to hit the backslash, right? And then you're going to type agents. So what's going to come up is the manage agent configuration, right? So then we're going to select create new agent, and then we're going to make it for this particular project, right? And then we're going to generate it with Claude, and then we're going to describe, right? Describe what this agent should do, when it should do it, and be go eat. That is a running back, Devon A-Chain, snapping, just mossed the shit out of a DB. No, that was a linebacker. Let me just turn this. All right, Devon. Oh, it was just out of bounds. It was just out of bounds. It was just out of bounds. All right. So what I'm saying, I'm sorry, I'm trying to do two things at once, or whatever. Describe what this agent should do and when it should be used. All right. Option creating, option trading bots. So just make it that simple. So creating option trading bots. All right. Boom. So what it's going to do is going to generate the agent from the description. So then once it generates it, then we're going to be able to pick a color. It's going to give it a nice little title. My only thing with using this, and I don't know if I'm going to use it or not, because I mean, Anthropic, in essence, this is still an AI agent, so we don't need to create another agent. The only thing I don't like about it, it doesn't give us as much feedback, right? And this is what I'll do. I'll create FADEBEAR with the AI agent. So all tools, we're going to use all tools. Oh, that's fun. And then we're going to select which model we wanted to use, right? So what I'm going to do is inherit from the parent, because I always use Claude 4.5. That's the best one that I've seen so far with regards to the performance. Yes, Sonnet is 4.5. It is Sonnet 4.5. I'm not using Opus. It's not worth the bang. And Opus is the most expensive one. So I'm not using Opus or Opus. It's the most expensive one. It doesn't make sense to use it, right? And Haiku, that's for like simple shit. Oh, create me a calendar or create me a position tracker, like very, very simple things, right? So I'm not going to use Haiku. So the reason I'm going to say inherit from parent, because we always use Sonnet 4.5. All right. And then we're going to select a color. We're going to use yellow. All right, perfect. So let's read this. So name option trading bot, right? Inherit from the parent. Use this agent when you want to design, implement, or optimize algorithmic option trading strategies. This includes developing trading logic, risk management systems, market data analysis, backtesting frameworks, and execution and it keeps going, right? This is the system prompt. You are an elite quantitative option trading specialist and software architect with deep expertise in derivative markets, algorithmic trading systems, and financial engineering. You combine, I wish it gave me, but I can't see it. And it keeps going, but let me just say, you combine advanced knowledge of option theory and then market, and then it cuts off, so I can't really see it. There's an ellipsis, just as it is here. So then we're going to hit continue. So now we have our agent, right? Then we're going to hit escape to go back. So now we have our agent. Now we're going to bring up our agent. So how we bring up our agent is, do you see the specialist or the agent profile we just created? Again, you treat it like it's a deposition. When you go to a deposition, the lawyer is not going to ask you a question that they don't already know the answer to, the highlights of the answer to, right? So again, I know the answer, so I'm going to answer the question. Oh, yes, I can see that the option trading bot agent was just created. Looking at the agent description from the task tools, it is designed for design, implement, or optimize the algorithmic option trading strategies. This includes developing trading logic, risk management systems, and market data analysis, backtesting frameworks, and execution systems for option trading. This is perfect for what you're working on. This agent can help with analyzing your strategy, optimizing the parameters, building dual trading systems, designing risk management. Just tackle. Thank you. Pump me my ball back. Design risk management systems, creating backtesting frameworks, or building trading execution logic. Do you want to launch this agent to help with something specific? All right, so what we're going to do is we need to create the actual bots for MEANIEBEAR and FADEBEAR. Review as references for previous bots that we have created. And now let's discuss how we can use and adapt for what we are doing here. Outline, plan before we get started. All right, and what we also have, what I forgot to show y'all, remember I said that this strategy is very market regime dependent, right? So we have a market regime detector. So what it does, it looks at the market. Let me turn this volume down. So it looks at the market, right? And then it tells us, based on the market, which bot we should run, right? So let me run it first, and then I'll go over the code. And then what we're doing is primarily I use Python. The reason I use Python is because that's one that I was trained on. I do know JavaScript a bit. I do know what am I saying? I do know JavaScript. I do know R. I do know TypeScript. I do know a little bit, not that much, bruh. A little bit of but nonetheless, the main languages that we're going to be using here is Python. If there's anything different, then I'll let you know. But mainly when it comes to algorithmic trading, it is going to be Python. There's a little bit of Rust that we can use, but we don't need it. I do know Rust, but you don't need it. That just makes it a little bit faster, just a little bit, right? But with Python, it gets the job done for what we're doing, right? So as you can see, our regime detector, what it does, it pulls in the real-time VIX. And remember, we're using VIX because that's how we determine which bot we're going to use, right? So VIX right now is 1637, right? And it's connecting to Alpaca in order to get the SPY data, right? So what is determined is that we're in a low VIX trending, right? And the strategy that we should be using is our MEANIEBEAR, our momentum breakout strategy. Reason being so is because VIX is less than 25, right? Low volatility trending environment, right? So every day before we run our bot is that I run this real quick. All right, which one should I run? And I created this with AI. It is super simple to create. So let's go back here. Damn, the thing that sucks is about the compact. So I'm going to have it create a plan. And once it creates the plan, I'll have the next agent pick it up because this sucks. All right. The current reference bot architect. Okay, excellent foundation. So we have the hybrid tracker, the VIX volatility adapter, the multi-source, the regime filter, risk management, manual control, right? MEANIEBEAR, LottoBear, MEANIEBEAR. All right, bear bot. Okay, what we want is two separate bots, right? We want a MEANIEBEAR and FADEBEAR bot. Now, with this in mind, let's go over plan before we actually start coding. All right, Taj, break. Yeah, let me cut this up a little bit. All right, so I just had to update it real quick just to let it know that, hey, I don't want because what it was trying to do is just create one bot and then have the bear and then the fade strategy. I don't want that. I want two separate bots, right? So one specifically for momentum, one specifically for mean reversion. All right, so this is what we want here. All right, give us the plan. Once we have the plan, I'm going to make it create and that's interesting. You just went from 7 to nothing. Let me see when it outputs it. Because once it outputs, then maybe we'll be able to update it accordingly. Who are you? Oh, Jalen Wright, bro. I have not seen you all season. I've seen you like maybe 3 times this season, Jalen. Where have you been at? All right, so let's look at this again. All right, you're right. Two completely separate bots is cleaner and safer. Let me revise the plan. And then we have Bear Baby. We have the Bear Mini Bot. Then we have Fade Bot. Then we have shared infrastructure for reuse, connection, Alpaca. It does exist. Don't say if. Reference, backtest. Okay. Two processes need to run. I understand that, bro. Just follow me, bro. Don't follow me, but follow me. We have our configurations based on the back test. All right, so this is looking good. We have our fade. All right, built me then second. All right, I like this. Just in case, because I think it's going to compact. So, or should I just go? All right, hold on. Let's just run. And if it compacts, it's going to be here already. So here is Alpaca. Here is everything needed for IBKR. I love it. Let's do this one at a time, and after each step, make sure to test without the use of mocks to ensure properly working. Do not use fallbacks or placeholders or cache functions. Make sure you use these. Make sure to use the agent. Let's start with mini bot. All right, so you all, I want to do this twice, right? We're going to do one with mini bot, right, and then another one with fade. I'm using Claude Code to be able to get this done. Now you're going to see one done with the AI agent, and you're going to see one done just with Claude, the Anthropic without the agent, and I think it's damn near going to be the same thing. But hey, I'll let you compare and see what we're going to be screaming, right? And this is going to take anywhere between 5 or 10 minutes. Now, depending on if it compacts, give it another like 10 minutes or so. So in another 25 minutes, we are going to have a bot ready and running and spinning. So let me show y'all. Oh, you know what I need to do? Let me just open IBKR real quick because I know I'm going to need that. So let me just open that. Run the ball. That's all we have to do. Run the ball. Oh, hold on. All right, so you see it's using the AI agent. Now it's building MEANIEBEAR. I still can't believe we lost to Cleveland. All right, here's IBKR. What I also want to pull up is a bot so you can see that. Hold on. But this is 2 down territory. All right, Ollie, give me my first, Ollie. Thank you, Ollie. Where is it? What I'm going to do real quick. Boom, boom. And y'all just forgive me. What I'm going to just grabbing our bot so I can show you how one works. Lotto. I need to organize this better, and I'm going to. Oh, this bot does have machine learning too. I forgot about that. Oh, look. Okay, you ready to run the test? Go ahead and run the test. All right, let's look at the first. So it created the configs. Let's look at the config file it created. Paper. Dynamic entry, validated from backtest. Okay. Tighter from Lotto. All right. Profit range, max hold time, no VIX filter. All right. Logging, symbol, fix, entry. I love it. It's using IBKR just like we needed. Theta data to bring in the option. We're using CSNBC to bring in our VIX, our validated. Okay, I love it. Now keep going. All right. Where's our terminal? Here's the terminal. All right, so let me just show y'all. We run it. Now, this bot knows when the market is open. This bot knows, right? It checks data, and this bot, as soon as the market open, it runs by itself, right? And then it gives us an output if there's any errors, any issues, or anything that's a first down. Give me my first down. Stop playing with me. Well, you look at here. Jip may be able to finish that. You just got to be safe. Don't lose my ball, man. All right, so you see theta data is online. It's checking VIX. It has VIX. No Greeks available because it's a Sunday, right? Market's not open. Market's not open. So what it's saying is that, all right, I'm going to check, but the market's not open, right? So it's fine. So let me just go ahead and close it. We know it works. It's good. Market's not open. It's not able to pull the Greeks. All right, thank you, Ollie. I was about to say, bro, if you got stopped, and this is IBKR, and IBKR is what we use for paper trading. And as you can see, I mean, we are doing all right. It ain't nothing too crazy. So I'm just gonna let that go. All right, perfect. It just made the bot. Now let's look at the bot. All right, let's look at our bot. It's running a syntax text. Go ahead. All right, it's checking, making sure that it can pull the data. All right. So we have our MEANIEBEAR, and then we have our actual bot for the MEANIEBEAR. So I love it. Profit targets. We have our stop loss. Okay. MEANIEBEAR live. 5 bar. Okay. All right. So we're looking Gucci. We're looking Gucci. Oh, it's running the bot now, so it wants to see how I'm gonna run it too. I want to see how it is. So let's run it in our terminal. I gotta grab a new one. Grabbing a new terminal so we can check our bot and see how the oh look, we got a log. What am I doing? CD. And CD is to get to the folder, and our terminal is basically our terminal for the computer. So CD is how we get to that particular folder. Now, so when I'm in the folder, you're going to see it. Baby Bear is right here, and this is the name of the folder, right? And now I'm going to grab the actual bot, copy. I need to copy the path. Then I'm going to put Python in front of it because this is a Python file. I'm going to copy the Python file, and then it should run with no issues. Let's see. Let me go look at the log that just outputted. Oh, this is from all right, perfect. So you can see we're running. We have another bot, ladies and gentlemen. Failed to get VIX. VIX is not open right now. Market is closed. We have to wait until the market is open. Theta data is not returning the info, so I want to check that. Why aren't you getting the VIX and theta data? I know the market is closed, but why aren't you getting VIX and theta data? So I want to make sure that is good, because you just checked it and you were Gucci. So you can see paper, we only trade between 9:45 and 11 a.m. The delta ranges, the exit rules, then it's doing its pre-flight checks, right? And then we have our hybrid account tracker, and I talked about that because the balance is a lot higher than what I want the bot to see. The only problem we're having right now is the VIX and then theta data. But it's outside of, I think it's just because it's outside of market hours. We're doing this on Sunday. So tomorrow when we run this, this should be fine. So we should just be able to hit kill, and we finish that up. All right, perfect. Now the agent, all right, that was cool. Again, the only thing is that I just wish it was more verbose, i.e. more logging. When the agent works, I'm not saying that it's not effective. The only thing that I'm saying is that, like, I don't know what the hell is going on. Like, I got to take your word that, like, you actually are doing this work. Yeah, I can go peek at it and I can go look at what you're doing, right? But I'd rather see it in real time as opposed to like doing this after the fact. So that's my only quorum with it. Right. All right. Now I created a README. That was just extra of you. A production ready automated trading bot with real time connection and manual controls. MEANIEBEAR is a momentum breakout strategy that trades zero days to expiration option, SPY option based. I need a touchdown. All right. 0 day 0 day SPY options based on the 5-bar price and volume breakouts. Unlike Lotto bot, MEANIEBEAR uses fixed parameters and trades in all market conditions. Not really. No VIX filter, a simple robust signal, fixed exit rules, trades all market conditions. Not really. Tighter delta ranges, signal, excuse me, I can't talk. Single profit targets, fixed trailing stop loss, short, hold time, core files, test files. And this is just a README. A README is like a manual. Get in there. I thank you, man. All right, man, let's run it. So we have our agent. It just created our first bot, and the only reason it's not working right now because it's, again, the market is closed. That's fine. Okay, the option trading bot has completed MEANIEBEAR. Let me update the to-do list and show you what was delivered. And that's another weird thing, is that it talks as if like you didn't just do the work, right? See, the option trading bot agent has completed the MEANIEBEAR live. Like, you didn't just do it, but whatever. Or maybe what it's trying to say is that, all right, bro, like I'm sitting in the background. This is really an AI agent that's doing the work. But again, I really haven't like really looked into it. I know that it does great work, but the only thing is, again, there's not a lot of logging. So I have to take your word as to what was done, aside from us being able to do like quick cursory reviews. And you see 27 tools used, 81,000 tokens, 9, 10, almost 10 minutes, right? I got to take word as bond type shit that you finished it, as opposed to me seeing it real time. So that's just my only qualms with this one. I wish that it was a little bit more logging so we can understand what's going on. Bro, there's like 10 tests that you're doing. I appreciate it. It's like you want to know that you want to know that you want to know. All right. All right, let's look at it. The summary of the live trading bot. We have the configurations, all validated from the back test. We have full live trading parameters. We have the tests. We have the README. We have the quick start guide. All right. 5 bar. All right. 100%. Beautiful, beautiful. Ready to run. On port, data, a pack of keys. All right. We Gucci. Already tested it. It's ready to go. All right. Perfect. Now let's proceed with FADEBEAR. All right, so you can see, I mean, the process gets a lot more quicker once we like actually flush the information out and we allow the AI to start coding it for us. And I think it's going to use the AI agent again. I should have said no. Don't use it, but let's get it in. Well, and let's finish this up. And like another 10, 15 minutes or so, we'll be done here. And you all have seen the entire process, right? From us being able to explain options and being able to go through that whole rigmarole, right? And being able to see us. The only thing that you didn't see is actually the development of the strategy. And I guess I'll do that because I have a few more that I want to be able to create. So I'm going to do that. But again, I do that more so on Twitch. This is my first time going live on YouTube, and I like it. It's a lot more stable. I'm not going to hold you because there are times with Twitch, like I got to keep looking. Are you good? Are you really good? Are you sure you're good? Am I tripping? Right? Whereas YouTube, like this is a lot more stable, bro. So I can appreciate it. So hold on. 0 DTE. That's crazy. The Bengals are up 10th. I expect, you know who I expect to go defeated this year is the Jets. Jets are gonna go defeated, bro. 100 to oh, that's crazy. That's crazy. The audio streaming is lower than the recommended bit rate. Okay. Can y'all hear me? Is there a problem? I don't see any latency issues. It says that it's correct. Let me just check something. That's crazy. Yeah, no, I can hear me fine. All right. We're waiting for the bot to finish up our FADEBEAR. And once FADEBEAR is done, we would have finished both our bot, explaining what options is, creating a bot with AI. And we're going to do next time. I'm going to maybe spend a little bit more time over here on YouTube because it's a little bit more chill. The only thing is like I want to make sure that you all can see, which I'm pretty sure you can. But if you can't, shoot me a comment and I will try to see what I can do to help. FADEBEAR. So it just dropped the configs for FADEBEAR. Let's look at that. All right. I remember fade bears are mean reversion strategy, whereas meanie bears are momentum breakout. That's why it's meanie bear MB. And fade bear is just like, bruh, I'm fade with it or fade out. So that works. Perfect, perfect. So you're seeing us create our bots, right? Or our algorithms, right? Bot is just the colloquial term that has just been attached onto, but it's an algorithm, right? So we trained our algorithm with our back test. Our back test has validated that it is robust enough to work across different years, but it is market regime specific, meaning that we have to be in very specific markets in order for this to work. So when we actually paper test this tomorrow, I'm going to be excited for you all to see. And I don't know if I'm going to if I want to be on Twitch or YouTube. I may be on YouTube. I'm not going to hold you. Like, this has been a pleasant experience, and I really do appreciate you all helping me out with this. So, but nonetheless, I'm going to be running it tomorrow, and then maybe running for like 1 or 2 days. And while I'm running it, I'll create. There's this other strategy that I really want to be able to figure out, like, get through. And this is this QQQ strategy. Like, it has a lot of potential, but it's taking me a lot longer than I've done. So maybe I'll start that from scratch tomorrow while we're paper trading, so we can actually get that strategy done and out the way. Because our SPY, I'm good. Like, I know how to do that, and like, I'm Gucci with it. But with QQQ, like, there's just a bit of divergence with it. So that's why it's just taking us a little bit longer to be able to kick that one out. But it's not like we're not having great performances, right? Because the performances are good. So I'm seeing great results within it. But there's just a couple of things that can be better, right? Look at that, man. My fins are up. The first quarter, we're up 7-0. I understand these boys are driving, but you got to take your wins. And I'm going to take my win. Are the Browns? I think the Browns are going to win this game. They're like sneaky good, bruh. I don't want to say that, because they are who we thought they were, be, kind of, maybe. Probably though. Probably though. Probably though. Dum dum. Dum dum. Dum dum. So I'm just waiting for the bot to output here. Okay, it's checking everything. So it just finished with the fade bear. So fade bear bot is good. Let's go check that out. So fade bear is good. Again, I just wish, as y'all can see, like, we got to trust that G is doing this work. I really can't, aside from like actually looking at the log, like, it leaves us here in limbo. Like, I wish there was a little bit more logging or output just to let me know, hey, I'm doing this, hey, I'm testing this now, hey, I'm working on that, hey, I'm thinking about this, right? Just so I can know what the heck is going on. Our position class, excuse me. All right, it's testing. VIX is not going to, I mean, you can't get it, but it's going to be kind of stale because the markets are not open. When the markets are open, then we can get it. Update the peak price, profit check equals 60%. I'm just checking the code just to make sure there isn't anything like, okay, what are you doing? And what the agent is doing right now, AI agent, is just double checking his work, right? And while it's double checking, I'm double checking just to make sure there aren't any issues here. So if you all have any questions, you can let me know and I will assist. So, okay, here's the actual bot configurations. Self-logging, trading, performance tracker, configurations. Okay. Logger setup, fade. I love it. Spike versus reversal. Initialize IBKR. Initialize alpaca. Initialize account tracker. Fetch the current VIX from CNBC. Okay. Investing.com as a backup. Get the 1 minute from, okay. So you see this one took So as you can see, bruh, it's like it's doing all this work. Yes, I can see you're outputting, but again, I just wish there was just a little bit more feedback as to like what you're doing and why you're doing it. You know, so it's running a test right now on FadeBear, what we just completed, right? The bot that we just completed using Claude code, and now I'm just reviewing the code just to make sure there isn't anything too peculiar. I think that in peculiar is a bit so negative. Yeah, you don't need it. Yeah. Oh, we don't do market orders. See, I'm glad I caught this. We do limit orders, not market. Okay, so I need to change that. I probably need to update that first thing because I need to show it how to do a limit order. Because market order, remember, we paying the bid straight up. Market order. Market order is not what I want, is limit orders. So I'm glad I'm reviewing this because we do market orders on the buyer, on the buy, we're paying too much. On the sell, we're leaving money on the table, right? So that's why I want to use market and limit orders. And it's supposed to be limit orders anyway because like it's all right. I'm not going to argue with you, but okay. So it's probably, if it's here, it's probably over there too. And this was line, let's call it from 695 to 790. That's 200 lines of code. No, 100 line of code. 695, 796. 695, 796. Okay. Update daily. Oh, snap. I forget what I'm here for. I'm not here for you. Good work, man. Get the Greeks. Perfect. Run pre-flight check. Okay, the only issue is the market order. Remember, we don't do market orders, we do limit orders. And the file is 1200. Now, my rule of thumb is anything over 1,000, you better have a damn good reason. Like, I like to keep it under 1,000. It's a lot more manageable, right? We said 695 to 795. 695 to 795. Let's go look. 690 market. Okay, so I need to keep track of that. So 695, 795. I need to update. Okay, so the market orders, and how long is 1200? Again, it's a bit too long for me, but it's kind of justifiable with everything that we're doing there. I mean, yes, I can take out the position tracking and make it a little bit more modular. Yes, I can take out the other stuff like being able to create the actual options and make that a little bit more modular. Maybe I'm going to do that. I don't know. But one thing I do know is that we accomplished a lot of great things here today. As soon as this bot outputs, is that we'll be done, right? We went from being able to explain our options. We went from being able to show you the back test, and now we're finishing up creating the AI agents. Again, the only part of the process you didn't see, you kind of did if you go watch the other videos on the channel, is how we actually went from the germination of the bot, or the trading idea, how I use ChatGPT, how we created the back test, and then running through the back test, going through the data and stuff like. The only thing that I'm not going to put on here is how we get the because getting the data, I get it from Theta Data and Bar Chart, and IBKR and Alpaca. Downloading the data is another story. Sometimes I can take hours. I'm not going to sit here and just wait hours for the data to download. I think that's dumb, right? So I'm not going to do that. So that's the only thing I won't bring up. But everything else, we running. Oh, this bot. All right, let me go run this bot now. And this one should work. All right, let's run it. Again, my quorum is that I am barely seeing, we're not seeing anything, right? I got to trust that you're doing it. So I just wish you were telling me a little bit more. So good, just like we expected. Market is closed. we're seeing these 2 errors because the market is closed. The market was open, it'll be good. This is the FADEBEAR, right? So we're seeing everything that we need to see. We see the VIX, 22 tools, 96,000 tokens, 11 minutes. And I'm supposed to just take your word you did all that. I guess you did. So let's go ahead and shut it down because it's working. All right, family. Yeah, I'm going to be spending a little bit more time over here on YouTube. It's just a lot more crisp to be able to stream. Twitch is fine too. I ain't gonna hold you, but it's just sometimes a bit of a headache. So I'll be spending a lot more time over here too. So I'll probably just switch it up. All right, perfect. So we have our bots. So we look at that. We created our bots here live with you all. So you're able to see that. So hopefully this week you'll see me go from the idea to the bot. So you can actually see that the beginning part of the process. But this part of the process, everybody always wants to see. Like, how do you create a bot? How do you create a bot? I just created one. You saw it from start to finish. You saw it from being able to go from the back test to the bot. So if you do all have any questions, please let me know. In the interim, I'll be back again tomorrow. We're going to actually paper trade these bots, right? And see how they perform. Again, I'm still deciding if I'm going to be here on Twitch because I can't forget about them. I still got to go show them love. But nonetheless, it is your boy Creative. We'll be back with another episode. I appreciate y'all for stopping by today when we were creating these bots. All right, we'll be back.